Happy Wednesday, folks. This is Darius Dale here to present our macro minute for Wednesday, July 13th, 2022. It's good to be back in the saddle. Asset markets, stocks down this morning, commodities mixed, crypto down, dollar up, global bond yields up. Market moving headlines. We have sticky inflation was not a surprise to those hashtag paying attention. You either pay attention or you pay the price. Inflation ramped up to 9.1% in June from 8.6%, topping consensus and reflecting higher gasoline and food costs. The month-over-month print came in at faster than expected, 1.3%. Prices are on a tear and set to keep the Fed on track for another 75 basis point rate hike later this month on the 27th, which is now priced in by money markets. The global liquidity cycle downturn continues to deepen. The Bank of Canada is set to deliver a supersized 75 basis point rate hike to 2.25% later today, its largest increase since 1998. The Royal Bank of New Zealand became the first central bank to move its key rate above neutral, raising by 50 basis points to 2.5%. South Korea increased by the same amount, its biggest ever move to 2.25%. So a lot of these international central banks are raising rates in sympathy with the Fed, just trying to maintain stability in their currencies, not allowing inflation pressures continue to increase through the terms of trade channels. So this is a globally coordinated liquidity cycle downturn that's going to lead to a globally coordinated growth, deepening growth cycle downturn that may ultimately culminate in a global recession. Obviously, earnings are going to take a hit on the path to realizing that outcome. Tina, anybody remember Tina? We were talking about Tina. Tina was the hot girl on the block at the beginning of last year, and I haven't heard anything from Tina. She hasn't texted me back in a while, but the percentage of S&P 500 members with the dividend yield higher than the 10-year yield has fallen to the lowest we've seen since 2007. Now, I'll repeat, the lowest we've seen since 2007 in terms of the percentage of S&P 500 constituents with a higher dividend yield, with the dividend yield that is higher than the 10-year nominal treasury yield. So stocks, there being no alternative to stocks, that's wrong. It's very wrong. And this is one of those signals. I mean, going back to what we discussed on the program last week, in terms of the deep inversion in the Eurodollar curve, being something that, we haven't really seen at this level since going back to 2007. Clearly markets are very nervous about something. And again, the Eurodollar is a hedging market, so it's not like the market expects that particular outcome. But what's really concerning is that the folks who are betting and hedging in the Eurodollar market, who are actually long a crap ton of risk on the credit side, on the equity side, they're actually nervous as they've been since then. And so this is one of those kind of statistics that kind of should raise your alarm bell in terms of the medium to longer term setup from a risk management perspective. And then lastly, consensus is getting bared up. I don't think I need to tell anybody that, but just kind of summarizing where we are in terms of how the sentiment is evolving in recent days and weeks. The Fed is forecast, so Jamie Dimon was out, obviously CEO of JP Morgan, said the Fed's forecast for 4% inflation this year is too optimistic. He said that to a French newspaper, Le Figaro. A soft landing in the U.S. and Europe is less and less likely. Speaking of, the IMF cut its 2022 U.S. GDP forecast to 2.3% from 2.9% it projected just a month ago. So in 1 month, we've lost 60 basis points from the IMF's U.S. GDP forecast. That 2.3% is just shy of it's actually higher than our trend growth rate of 2.0%, the pre-COVID trend growth rate. So they got a little bit more work to do in terms of getting that number in line with where we are at 42 macro. It also lowered next year's estimate. And then lastly, at Fidelity came out and said the U.S. has moved closer to a hard landing while recession in Europe looks very likely. So folks are obviously getting very bearish. The markets are obviously in a precarious state. We've seen a lot of sell-off. S&P's down over 20%, NASDAQ down nearly 30%, et cetera, et cetera. That doesn't necessarily, just because everyone is bearish doesn't mean they're fully positioned bearish. And this goes back to the positioning cycle analysis we outlined at the beginning of this year that said in sort of investors' holdings of equities as a share of their overall net worth was the all-time high. I mean, like well north of what we saw at the peak of the dot-com bubble. And rolling off that all-time high obviously tends to come with a decent amount of pain. So investors are obviously very nervous. If you look at Eurodollar markets, et cetera, they're obviously very bearish if you just listen to what they're saying on podcasts and on TV and in publications. But has the positioning actually changed in a way that suggests they have adequately positioned for a recession. And when you look at our data and our math on all that, on all those statistics, on all those dynamics, we continue to say no. Big movers this morning, NASDAQ 100. It's actually rallied since I wrote this, but the morning of this morning it was down 1.9% to off 2.6% month over month. Bitcoin and Ethereum were off 2% a piece to down 18 and 17% month over month, respectively. And then you have the 2-year nominal Treasury yield up 14 basis points to 3.19%. That is the same rate as the 30-year Treasury, so almost flirting with a 2s 30s inversion here. And then that 2-year Treasury nominal Treasury is up 13 basis points month over month. Taking it to the chart here this morning, I just want to show a couple quick charts before we get into the VAMs and probable ranges. Houston, we have an inflation problem. So headline CPI. So what I'm showing in these charts, the prior 3-month season adjusted annualized rate of inflation, the latest. So we're taking a 3-month annualized rate of inflation and just showing that in rate of change terms on a month-to-month basis. And headline CPI, fastest we've seen since March of 22. Food CPI accelerating on a 3-month SAR basis to the fastest we've seen since November 80. Energy CPI came down, and we saw that in the price of energy. But guess what? It didn't stop inflation from continuing to rise, because guess what? Inflation is not just the chart of energy. I've been saying that for a while now. Finally, people are listening. Houston, we also have a core inflation problem. So core CPI, X energy, X food, all the stuff that you can see ticking on the screen every day. This is a real big issue. So core CPI on a 3-month annualized basis accelerating to 7.7%. That's the fastest we've seen since June of last year, so a full year ago. Core goods CPI, which was the saving grace for core inflation and core PCE for a while, is now kind of moving significantly in the wrong direction again. Again, China's zero COVID may take energy prices down, but zero COVID also inflates core goods inflation through the terms of trade channels. So this is you can't have your cake and eat it too. I've been saying that all year as well. You're seeing core goods CPI accelerate to the fastest we've seen in 4 months. And then lastly, core services CPI, which is something we've been pounding the table on for months now. And part of the reason we're seeing this reacceleration in inflation in the middle of this year, that's the fastest on a 3-month annualized basis we've seen since August of 1990. So I don't know if the folks you're paying attention to for free are giving you this kind of information analysis and really digging into the data for you in order to actually help you position ahead of time for some of these market events. But certainly on the days like today when the data are reported, we know for a fact that 42 macro subscribers are well positioned ahead of time for that. So we just want to make you guys all aware of that. Getting into our volatility adjusted momentum signals and probable ranges. US dollar still bullish, fams. That's still overbought there. Gold bearish, fams. That is still oversold, deeply oversold. 10-year nominal treasury yield bullish, fams. Getting to the lower boundary of its probable range, but obviously backing off a little bit this morning. Post CPI bullish, VAMs. High yield credit spreads not quite oversold there, but very close. We would not be chasing credit here. Very bad place to be chasing credit. S&P 500 flipped to neutral, VAMs earlier this week. So you got about 3.4% of downside versus 4.2% of upside. So somewhat of a fair fight there. You don't need to, the S&P doesn't need to go to 3,400 or 3,200 overnight. This is going to be a process. It's going to take incremental months of data, incremental quarters of, quarterly earnings, incremental tightness out of the Fed. It doesn't all have to happen today. We just need, one by one, week to week, month to month to month. We need more people to go from one side of the boat, which is levered long of risk, to the other side of the boat, which is capitulating that levered long of risk view. We've seen obviously a decent amount of that year to date, but we are certainly not seeing the full brunt of what we expect just from our, liquidity cycle analysis and growth cycle analysis. Oh, and by the way, the profit cycle analysis perspective. VIX neutral, VAMs, that's in the middle of its range here. NASDAQ 100, that is still bearish, VAMs. You got about 6% of downside or less than 3% of upside here. Russell 2000 also flipped to neutral, VAMs. Fair fight as well there, minus 4.6% of downside versus 5% of upside. Bitcoin bearish, VAMs, more or less a fair fight, 12% of downside, 8% of upside. Ethereum bearish, VAMs. Fair fight here, 13% of downside, 12% of upside. Shanghai Composite bullish, VAMs. Oversold finally. I mean, we haven't had an oversold signal in China since going back to late April. I mean, it's mid-July. So if you haven't been able to, but if this is something you wanted to buy, that you haven't been able to buy China, you're definitely getting an opportunity there. WTI crude oil bullish, VAMs, still oversold, still breaking down. When does that transition to neutral and potentially bearish, VAMs? As we're obviously continuing to see the growth cycle deteriorate, certainly from a real perspective. I know a lot of folks out there is nominal, but guess what? Nominal is not bailing out year to date, so pay attention to the real. Agricultural bearish, VAMs, kind of in the middle of its range there. And lastly, industrial metals bearish, VAMs, towards the lower bound of its probable range, not quite oversold yet. So with that, Darius Dale presenting our macro minute for July 13, 2022. Best of luck out there today, and we'll catch back here tomorrow. Cheers.